If there's something on your credit bureau that needs to be fixed, let's say there's an error, there is something that should have been removed 3 or 4 years ago and it's still there, that's the time to do it. You don't want to wait until my first property. I had no idea what I could do. I had absolutely no guidance. It was a very, very stressful experience. I went to the banks. I did not know that I had options. Why am I paying off a 25-year mortgage? Why do I have to wait for 25 years? There's ways to do it faster. I figured out with research that, these are the things that I can do to pay off my mortgage.
So you walk into the Red Bank just because you have an account there thinking they will give you the best product that there is. But the fact is they are only going to give you what they have.
That's right. It is designed for the client to stay in-house. Your parents say, well, we loan you the money. That means that there's additional debt. So now we can't qualify you for the amount that you're looking for. Whereas if it's gifted, it's a gift. It's your parents are gifting it to you.
A lot of the gifted down payment comes from abroad. So how do things change in that respect?
The lenders are very, very strict about this. If you're bringing in money from another country, have them in your account no less than days.
I am Shay Sharma and welcome to yet another episode of the Shay Sharma Show. As promised, we are continuing to deliver more value with more episodes, and first episode of 2025 is here. Today, we're going to cover everything about real estate. Just kidding. We're going to cover a lot of things with respect to where the market has been in the last 2 years, what's happening right now, where we're going in 2025. So if you're a first-time buyer, a home seller, or an investor, or anybody who's making any moves in real estate in 2025, this episode is going to be super relevant for you. Today, I'm joined by one of the best mortgage advisors I know, Sonia. Welcome.
Thank you, Shay. Nice to be here.
Thank you for coming. In Toronto in the afternoon, beating all the traffic. So thanks for being here. And thanks for the lunch, by the way.
Oh, you're welcome. It was my pleasure.
Great. So I do say Sonia is the best. And yes, I do say that about all my business partners because they're all super amazing. But for people who don't know you, let's see who Sonia is. So give us like a comic book story of your life, your career, anything that you'd like to share.
Well, I have been in the industry for 3 years. Mm-hmm. I came into the industry by default, really. I retired from a very lengthy career a few years ago, and I decided that I wanted to do something else. Mm-hmm. So finance was it. It's something I've always wanted to do. I'm very passionate about real estate. I'm very passionate about financing. And I decided that this was the perfect venue, the perfect new direction for me to take in my life. So here I am, 3 years later.
And where does the love for finance or numbers come from, if you don't mind me asking?
I've always wanted to go into finance. Okay. It's just that my personal experiences purchasing a property, my first property, I had no idea what I could do. I had absolutely no guidance. And it wasn't a great experience, to be honest. It was a very, very stressful experience. When I purchased my second property, I didn't have any guidance either. I went to the banks. I did not know that I had options. And I was never really told that I had options. So I just stuck with what I was presented. And through the years, while I was paying off my mortgage, and I started, researching and figuring out, why am I paying off a 25-year mortgage? Why do I have to wait for 25 years? There's ways to do it faster. I figured out on my own, with research, that these are the things that I can do to pay off my mortgage. These are the options that I have available to me, but they were never presented to me. So I thought, what? This is something that I would like to explore deeper. This is something that I would like to know more about. And so when I retired, I said, what? This is the perfect opportunity for me to educate myself, get the knowledge that I need so that I can help my clients, I can help my business partners and my referral partners to get their clients into a better place, and also show them that there are options. You are not stuck with just one product or something that is presented to you in one financial institution when there's so much availability out there through brokers. I didn't even know that there were brokers out there when I purchased my first home. So this is a totally new chapter in my life, but also a very exciting chapter because I get to share my story in real estate, and I also get to share the things that I did to pay off my first mortgage and to put myself in a better financial situation to be comfortable in life.
And a very successful chapter at that, I must say.
Thank you.
And you brought about a couple amazing points. I wasn't planning to ask it in this segment, but I think you gave us a great segue. Now, the first is that you have less information when you're just entering the market for the first or even the second time. So I think most people, the mistake that they make is they go to the bank that they bank with. So you walk into the red bank just because you have an account there, thinking they will give you the best product that there is. But the fact is they are only going to give you what they have.
That's right.
And if you walk into the blue bank or the green bank, the story is the same because they will only give you what they have. But I think that's where a mortgage advisor comes into play, because you guys now have access to, let's say, 10 different lenders and 40 different products, and you will take the time and the effort to understand the personal and financial situation of a client in great detail and then recommend the best product that fits their requirements.
Exactly. See, there is nothing wrong with getting a mortgage in the bank. First of all, even the lenders, they're all banks. Except that the difference is when you go to a bank, they cater to their product. They want to keep the product in-house. And so it is designed for the client to stay in-house. If I go to one of the big five and, I can't qualify through my bank, they're not going to say, Sonia, go somewhere else. They want to keep me in-house. So whereas if you go to a broker, if I have a lender that is very specific for the client, that caters to what I need for the client, then I can place that client with that lender. Now, if something doesn't fit into their bucket for the product, I have the option of taking the client somewhere else. So in the broker channel or in the mortgage channel, we have access to many, many lenders. They're prime lenders, alternative lenders, private lenders, and there is something that will fit a client or a client profile. A mortgage is not a one-size-fits-all, as you know. There's so many aspects that are involved. And so the difference between a bank and a mortgage broker or a brokerage is that a bank is limited to their own products, whereas the broker channel has the doors wide open to take the client to a lender that will suit their needs.
Absolutely. And since this question came up randomly, I'm going to go back to your story now. So you said you had a very long career prior to becoming a mortgage advisor.
Yes, I did.
What was that all about?
I was in aviation for 37 years. I started flying when I was very, very young. And you know what? I like to think that I lived my life backwards. I did all the exciting things in my younger days. I traveled the world. I've done some amazing things. I've seen some amazing things. I've seen some not so amazing things. But you know what? It's taken me to a really great place in my life. And it's also allowed me to have a totally different perspective on how to see things, on how to approach problems, how to solve problems. It allows you to have a very free mind, very non-judgmental. I like to think when I speak to my clients, it's, you're coming into a safe space. There's no judgment, because at the end of the day, it doesn't matter who is sitting across from you. It's a person. You don't know what the person may be going through or what they may have gone through. They're a person, and they deserve to be spoken to with respect and with kindness, and they deserve to feel safe. Nobody wants to be judged on their situation, or not everybody has the fortune or the privilege to be in a certain place in their lives. Everybody has to work very hard to get there. And so to allow people to be themselves and feel that, they can tell you anything with no judgment is very empowering, not just for us as brokers, but for the client as well, because they'll trust you. They'll keep coming back to you.
Right. And I think since you dealt with people for decades, right, I think the skills that you would have acquired in that space would be completely transferable and useful even today in your new career. Is that a right assumption? Absolutely.
There is a comfort and a level of ease that comes to speaking with people. And, in my previous career, I was exposed to thousands of people. I've met many, many people from all walks of life. And when you're in confined space, everybody talks to you. And so when people talk to you and they're comfortable with you, it usually takes 2-3 minutes. They will tell you their life story. And it doesn't take much to be kind or to just say, I'm here to hear your story. I'm here to listen to you. And when people get that feeling or that sense from you, they'll keep coming back. It's instant trust. And that's it's trust that's not necessarily easily fostered in all kinds of environments. But, in the broker channel, it's very much the same. If you allow somebody to feel comfortable with you, they're not going to go somewhere else because they already know that they have found a safe space, a safe space.
Yeah. No, that's great. That's great. So now for the first segment of this show, let's talk about the real estate market a little bit. Now, we've both been very active for the last few years, I'd say. But essentially what I want to focus on right now is the last couple of years. So if I really have to kind of crunch all of that in let's say a few sentences, then this is what happened, I guess. And feel free to chime in. So about 4 years ago now, March 2020 is when COVID hit. So for the first couple of months, there was a lot of uncertainty in the market. People really didn't know what to do or what's coming their way. So the market was at a halt. But then the government of Canada, the Bank of Canada, decided to lower the interest rates to pretty much zero. So free money at that point. So a lot of liquidity came into the market. We consumed over 5 years worth of goods and services in about 2 years. What followed from there on was that the real estate prices really jumped. They peaked till about 18 months from March 2020 to about Feb 2022, where the Bank of Canada had to step in saying the inflation is too high, we've kept interest rates too low for too long, now we got to push brakes on this thing. They started reducing the interest rates and the prices came down. They've been pretty much flat for the last couple of years. Now, where we are right now in January of 2025, we've already had 5 interest rate cuts. But we're going to talk about 2025 a little bit later on. But the last couple of years have been pretty uncertain, pretty scary for a lot of people out there, irrespective of whether you're a home buyer, homeowner, an investor. Like, people have been hurting and there have been a lot of challenges. So in your day-to-day, what are some of the challenges that you feel people have faced and they might continue to face it in 2025 as well to an extent?
You know what? Carrying their monthly bills, their mortgages. During the pandemic, the market overheated. We saw the lowest rates in history, and we saw the highest real estate prices in history. Probably, I don't think we'll ever see real estate prices like that again. It was a lot of free money. And people went crazy. Also, the sellers went crazy because now they could get a lot of money for their properties, which is in today's market, very unrealistic. We'll never see that again. High interest rates are what's killing the market right now. They have been killing the market the last 2 years. Level of affordability. We went from 1.5% rates to 4.5 or 5% prime rates. People with variable rates, who didn't know that they could lock into a fixed rate, are in financial trouble. So yep. It's been it comes with a lot of uncertainty. It brought a lot of uncertainty, a lot of scary times for the households. People couldn't afford their homes. Right. What they could afford 3 years ago, they can no longer afford. So the last 2 years have been scary and pivotal for a lot of families. Right.
And inflation also did not help, of course.
It did not. No.
Right, because now not only the mortgage payments go up, but the grocery bills and the heat and the water, now everything is all the more expensive. Well, your renovations are more expensive, so any improvements...
Import tariffs for builders went up, they skyrocketed. Yeah. It was just... globally, really, it was a financial distress. Really, I don't know any other way to put it.
Right. And then coming to home buyers now, For the last 2 years, I know that people have had trouble with affordability, as you mentioned. Now, that's because A, they weren't able to qualify for, let's say, the kind of home that they want to be in. And B, even if they qualified, what scared them was the monthly payments because of such a high interest rate. Now, given we've had a few interest rate cuts this year in 2024 and in 2025, the Bank of Canada is meeting again on January 29th and then in March and 6 more times thereafter. We will expect, or we do expect, more interest rate cuts to come in. How do you think that will impact the market going forward?
I think, the rates will come down. I mean, we are at 3.25 right now for the overnight rate.
Yeah.
I don't think that they will, personally, I don't think that they will lower the rates as aggressively as they have the last three cuts. I think it'll be very, very slow. They have to stabilize the market. We don't want to see the market overheating again. If we start to overheat, we're going to go back into inflation problems, and we're just going to keep, adding more stress to the current stress. I think it'll be a very, very slow rate drop over the next 12 months. Having said that, even where we are now, it's still better than it was last year. The people or borrowers who were looking at renewals last year were looking at $500, $600, or $700 more a month than they already had. The borrowers or the homeowners who are going to be renewing the next 12 months are in a much better position. Yes, their bills and their monthly payments will be higher, but nowhere near as what they would have been a year ago.
Right.
So I think it will bring some stability, but the rates are not going to drop at such a fast pace as we did the last 3 Bank of Canada announcements. It's just not realistic.
Right. And that also kind of brings me back to January 2023. Now, I agree with you, the rates shouldn't be dropped too significantly in a short time frame, just because, what I'm thinking now, 2 years ago, the same thing happened. Now, January 25th, if I remember correctly, in 2023, the Bank of Canada said, we're going to pause interest rates and then we're going to see what happens. They didn't say that the rate hike cycle is behind us or we're going to start cutting now, but they just said, we'll pause and see. But that somehow brought a lot of buyers back into the market. It gave them a lot of confidence. And what we saw happening from January to May 2023 was 150,000 increase in the average home price in the GTA. Now, if the same thing happens now, then the Bank of Canada, just as they did in 2023, they'll have to step back in saying, you might not be getting the message. So here's another interest rate hike. So I think for us to avoid it, A, the Bank of Canada should not cut the interest rates too aggressively, and B, even we guys, the buyers, the investors, have to be mindful that, it's just a slow transition right now.
Yes.
Not everything is under control at the moment. So let's take it slow.
Very true. I wouldn't be surprised if the next 2 Bank of Canada announcements, don't do a rate drop.
Mm-hmm.
If they keep the rate at where it is now, I wouldn't be surprised if they do that. Because we are still, even though they say inflation has leveled, they don't want to see the levels going back. They don't want to see that fluctuation. The consumer and we cannot handle that kind of fluctuation. We need to be able to keep people in their homes. We need to be able to afford comfortable living, and we need to be able to afford our monthly financial obligations. So I think the rates will drop, but they're not going to drop as fast as they have the last 3 announcements or 4 announcements. It's going to take some work. And the other thing is, will the real estate market fluctuate? Yes, of course it will. But we cannot expect, sellers or investors should not expect their homes to increase in value or market value by $100,000 just because the market is starting to heat up again. We're just not in that kind of environment. It's just not realistic for us to have that kind of expectation.
Right. I do feel, I agree with you, but I do feel that we might have another 25 basis points drop this month.
Quite possible.
And something of similar effect in March as well. And I think what the biggest point that in my head will heat up the market even if we don't want it to is the seasonality of the market as well.
Very true.
Because we're entering into the spring market. So statistically, we know 50% or even more transactions that happen in any given year happen between February and June or
In
July.
June, yeah.
So a lot of buyers will come into the market just because of the seasonality. The transactions will go up, in my view. And it's from there on a three-step process in my head. So first, the transactions go up, which means more homes are getting absorbed now, because of which the inventory comes down. And when the inventory comes down, now there's less supply. So more buyers are now fighting over less product.
Yes.
And hence the prices go up.
Yes.
So I think it might take a couple of months, but by summer or towards the end of the summer, we will see that the prices have gone up significantly from where they're at right now. And then they might flatline again because of the summer break and the fall market and the winter market, which will follow. But I personally think I might be wrong. I'm sticking my neck out a little bit by saying this right now, but I do feel we will have a significant increase in prices in the next few months. But anyway, we'll talk about
yes.
that more, as we go along. But now coming back to first-time buyers and why first-time buyers are important right now is because of the pent-up demand, I feel. For the last couple of years, people have not made moves. A, because they were scared. B, because they were uncertain.
Affordability.
But I know a lot of people in my circle, in my database, people who had the money, who had stable jobs, the jobs weren't going anywhere, yet they did not make a move.
They couldn't qualify.
They could.
They could qualify.
They could qualify. Like everything was there for them to make the move. They didn't make the move because of the uncertainty, that scare, that that feeling of what might happen if this or that.
Okay.
I know a lot of those people will now enter the market, or at least I hope they do, right? So I think we need to discuss a lot of things which are pertaining to first-time buyers at this point. Now, first thing that comes to mind is the 30-year amortization, right? That is now allowed for first-time buyers both in pre-construction as well as resale space.
Yes.
Right? How does that help a first-time buyer?
That is huge. 30-year amortizations will lower their monthly payments. 30-year amortizations were not available to first-time home buyers last year, especially if you bought a property that was over $1 million. Or, first-time home buyers had to buy a property under $1 million with 5%. They could not have 20% down payment. Now, first-time home buyers can purchase a property of up to $1.5 million with an insured mortgage, which was not available to them before. So that increases, their purchasing power on many levels. Not just purchasing power, but also the areas. They may be able to get into areas that they were not been able to get into before. So if somebody was looking at purchasing a property in Etobicoke before and they couldn't do it, and they were being pushed out to, other parts of the city, now they can purchase a property in Etobicoke. They also now have the ability to purchase a property under $1 million with a 30-year amortization. And it doesn't have to be a house. It could be a condo or a condo townhouse. So it opens up the opportunities for the first-time home buyers with just a 5% down payment, which is huge. Right. It also allows them to qualify with a better rate, now that the rates have lowered. So there's a lot of opportunity for first-time home buyers. And it's something that is very welcoming because, you know what, it was very limiting before. Whereas now it opens up the door for them to get into something bigger or even something that's more attainable for them.
Right. And then I also get a lot of questions with regards to RRSP. So I know the limit on RRSP was changed or even improved and increased last year. So how does RRSP now help first-time buyers with regards to their down payment?
Under the old rules, the first-time home buyer was allowed to take out $35,000 from their RRSPs. With the new incentives, they're allowed to take $60,000 from their RRSPs. So imagine if there's a couple and both have $60,000 individually in their RRSPs, that's $120,000 for a down payment. So they can take that money out with no penalty. However, they have to start repaying it, and they will have 15 years to repay it back into their RRSP account to avoid any penalties or being taxed. And I believe that the repayment starts within 2 years. So once they take that money out, as long as it is for a down payment for a purchase, for a home purchase, their financial institution, once the anniversary date comes up to start the repayment, they will take whatever the amount they took out, they'll prorate it over the 15 years. And that's something that the couple or the borrowers will have to budget for so that they can repay it back into the accounts without any penalties. It's a great incentive. You know, you don't have to get gifted funds from your parents. You don't have to look for extra funds or take money out of your savings if you don't want to take out your savings. Keep those, you know, because you're not, you know, you could have mutual funds, you could have whatever your investments are, take it from your RSPs. And there is no penalty to do that.
Right.
So that's a huge, huge incentive, and that's a great benefit for them. They don't have to take out 60,000. They may only need 30,000, but it's better than nothing.
Right, absolutely.
Right.
And is there a specific time frame for which the money has to be in the RRSP account before they can take it out?
It has minimum 90 days.
Okay.
Yeah,
Okay.
minimum 90 days.
Right. And another account which, in my opinion, is super helpful is the FHSA,
Yes.
the first-time homeowner savings account, home buyer saving account.
I always get confused with that one too.
So tell us more about that.
The FHSA account is a fantastic tool. It works just like an RSP because you get a tax return at the end of each year. You're allowed $8,000 per year for a maximum of $40,000. Now, you can take that money within your FHSA and invest it and grow it and use that for a down payment. Now, the one thing that the borrowers have to keep in mind is that money is for a down payment. If you were to take that money out and spend it somewhere else, you're going to be taxed on it.
Mm-hmm.
So it's a great vehicle to save money. It's a great incentive to save money. And with all your tax returns, you know what? You can put that money back in there so you don't have to worry about putting in the $8,000. If you're getting $3,000 back, now you just have to worry about the $5,000 to make up for the difference, you know, to the $8,000. So it's a great, great vehicle. If there's two of you, if there's a couple, and you each have an FHSA account, that's $80,000 right there, if you have the means to save that kind of money, of course.
Right.
And it takes time. But if you invest it wisely, you know what? You could build that account quite nicely if you have the right financial planners, the wealth management. It's very, very doable. Great,
Right.
great venues to save.
Right. And are there any restrictions when it comes to the FHSA account? Or are these the only points that one needs to be mindful of?
Well, you can't use the funds to buy a car. Okay, you cannot take the money out because you decide you're going to go on a shopping spree, or you need a renovation or you want to upgrade something in your apartment. That money is strictly for a first-time home buyer. It's designed for a first-time home buyer for your first home. So the restriction is if you take it out and it's not for a down payment, you will be taxed on it.
Yeah. All right. So we spoke about RRSP, we spoke about FHSA. Now, I get a lot of questions with regards to down payments as well. So if we can quickly discuss how the down payments are determined based on, let's say, a home value. Let's take $800,000 as an example. So if you could quickly explain how the down payment works and what are the different sources of down payment apart from, let's say, RRSP and FHSA.
So the down payment is very, very, it's a very important part of your home buying journey, and it's one that you need to be prepared for. So if you were to purchase a home for $800,000, we will say minimum is 5%, but it's prorated. So the first $500,000 is 5%, the balance is 10%. Okay, so you're looking at $25,000 for the 500, and then you're looking at $30,000 for the 300. So that's how
800,000 minus 500,000. So the remaining
that's right.
300,000, 10% of that.
10% of that.
Got
So
it.
you're looking at 30 plus 25, $55,000. So that's how the down payments are calculated. So now that we have properties of 1.5 million, let's say you purchase for 1.1. The first 500 is 5%, the balance is at 10%. So that's how the down payments are calculated. The forms of down payment: personal savings, your RRSPs, your FHSA, which you can combine with your RRSPs for down payment, or you have gifted down payments, which could be a gift from immediate family, which is your parents, your siblings, your grandparents. Those are the forms of down payments that are acceptable. Now, if you are getting a gifted down payment, you need to have a letter. And obviously, lenders can be very, very specific on what the template is going to be, on the format of the letter. And it has to specify that there is no debt associated with the gifted payment. In other words, there is no responsibility or no obligation to pay that money back. Because if your parents say, well, we loan you the money, that means that there's additional debt. So now we can't qualify you for the amount that you're looking for. Whereas if it's gifted, it's a gift. It's your parents are gifting it to you. It's a very, very different language, of course. Very different intent.
Right. And I work with personally a lot of home buyers who have immigrated to the country.
Yes.
Right. And in that case, a lot of the down payment, the gifted down payment, comes from abroad. So how do things change in that respect?
That is a little bit more complicated. When the funds come in from overseas, we look very closely at all the funds, but especially any funds that come overseas, especially now with the new AML rules. Okay, so those funds must be in the Canadian account minimum 90 days before they're used, and we have to trace them. We have to see the time of withdrawal, the time of deposit, when they came in, where they come from, and we also look at the countries where they come from. Unfortunately, we have to be very, very diligent. Especially in the times that we're in. And the lenders are very, very strict about this. So if you're bringing in money from another country or international funds, have them in your account no less than 90 days before we have to use them for a down payment.
Right. And you mentioned AML. Now, we know TD was very recently penalized for some of the AML practices that they had, which they're working on heavily now. Do you think that might have any impact on the market as far as real estate is concerned?
I think anything that's related to that will impact the market, of course. It'll impact the lenders. It'll impact the broker channels on how things are done, on how things are looked at. And there'll be a much higher level of scrutiny. And there should be, because
Absolutely.
It's not a situation you want to find yourself in, especially as an individual broker or as a brokerage, or as a financial institution for that matter.
Right. So now let's talk about the pre-approval process. Now, as a realtor, I always recommend that after the first consultation session that we've had, I direct them to a mortgage advisor, much like yourself, wherein the home buyers can first work with you to run their numbers, understand what they're qualified for. And then once they have that number, we get into a discussion again, which is, a realtor and the clients, wherein we talk about the requirements and the qualification numbers, see how these two things align. Because our focus is to meet the requirements, not touch the pre-qualification number, whatever that is. So talk us through the pre-approval process. How does that work? So if anybody comes to you, what are the steps that you take them through?
Well, just to clarify, pre-qualification is just an assessment. It's more or less a verbal assessment. It's, you say to me, this is how much I make, this is, what my debts are, and I can say, okay, based on the numbers that you are giving me, this is what I could see you qualify for. It's a qualification. A pre-approval is more in depth. A pre-approval, we collect the documents. We look at the income documents. We look at your employment. We go through all the numbers. We actually pull your credit from the bureau. And based on that, we, depending on where the debt ratios are, we want to make sure that you stay within the debt ratios that are set out by the parameters set out by the lenders, depending on obviously the property that you're purchasing or what the situation may be. So the pre-approval is actually done through the lender. We submit the documents to the lender. So when we get a pre-approval letter back, you know exactly how much the client can qualify for. You know exactly how much the client can qualify or afford as far as a purchase, a home purchase is concerned. It also, the actual pre-approval is a really good thing to have, because if there's something on your credit bureau that needs to be fixed, let's say there's an error, there's a line in there that shouldn't be there, or there is something that should have been removed, 3 or 4 years ago, and it's still there, that's the time to do it. You don't want to wait until you submit the actual application for a mortgage approval. So a pre-approval is really important because it also sets the expectation for the client. It sets the expectation that, this is how much I make, this is what my credit is, my credit score is, this is what my, debts may be, or credit cards, or whatever it may be at that time. And it sets the tone for what's to come. It also says to the client, you may be able to afford $800,000 for a house, but it doesn't mean that you have to go spend $800,000. Your realtor, like Shay, might be able to find something for you that is a little bit less, but give you more in value at the end of the day. So not only does it set up the client, the borrower, for success, but it also helps you in getting the borrower into the right home, because you know exactly how much they can spend.
Right. And what are some of the mistakes that you see people making before and after, the pre-approval process, or before and after they have an accepted offer to a house?
One of the biggest mistakes that I see is, there's a few, but one of the most important ones is multiple pre-approvals. And we've talked about this. Multiple pre-approvals, if you're going to purchase a home, work with one broker and one realtor. Multiple pre-approvals will go against you, because we see it on the bureau, and it's a flag for the lenders. Another big one is, don't buy a car while you're negotiating or while you're applying for a mortgage. Don't make a big purchase, because you are now adding debt onto a mortgage that you just diminished your borrowing power with the lender. So, big purchases, big vacations while you're waiting for your mortgage to be approved, big no-nos. Wait until you're closed, and then you can buy your fancy car, you go on your big vacation. But, avoid any big purchases while we're going through the process. And it's let's keep the numbers where they are to make sure that we can close and you can happily move into your new home.
Yeah. Like a car is so very common, it's not even funny anymore for us. So you mentioned, Sonia, that we should be working with one team and one realtor, one mortgage broker, and the way I like to put it is a power team for the client, for the buyer, the seller. Because to be honest, these are the people who will go to battle for you now.
Yeah.
Right? So you need to have a very strong team, and be a team you can really trust and you can work with. Now, realtors and mortgage brokers are kind of the first two partners that anybody starts working with. Of course, there are other people. There are home inspectors, there are lawyers, there are contractors. But these two people kind of, get the ball rolling for you, make sure you have the right start and you're set up in a perfect way. So what do you think is the importance of having a power team?
The importance of having a power team is very, very simple. It gets you to the finish line. If you,
with minimum stress and hassles.
Minimum stress and hassles, absolutely. I was going to say that next. A power team gets you to where you need to go. They are the heavy lifters in the process. As a borrower, what you should be doing is meet brokers, meet with realtors, interview them. Because you want to have somebody with you that you can trust, somebody that listens to you, somebody who's going to work with you efficiently and diligently. You also want to have a team that that the partners get along. They're on the same page. They have your interest, your best interest at heart. So, I always hear, I'm shopping for a rate. I'm shopping for a rate. And I say, you should be looking for a broker. You should be looking for a realtor. My job is to find the best rate for you. The realtor's job is responsible to find the best home for you. You should be looking for us. You shouldn't be looking for a rate. That's our job. That's, my job is the rate and everything else, and your job is to find the right home. So find and align yourself with a team who sees your vision, who understands what you're looking for. And, by being transparent with us and being honest and telling us what we need to know, we're not asking questions because we're being nosy. We're asking questions because we need to know so that we can guide you in the right direction. Tell us what it is that you're looking for, and you might be surprised. We might be able to exceed those expectations. Because you know what? Just because you say, this is what I have, this is what I want, we might be able to place you in an even better position than you're in right now, what you're hoping for. So to have the right team with you is very, very important because, like I said, we're the ones doing the lifting. We're the ones doing the diligence for you. We're the ones shopping for you. You shop for a home, I shop for a rate and the conditions. That's our job. That's not the borrower's job.
Right. Right. And a lot of people come to us, and I hope you agree with this because I'm sure you've had this experience. A lot of people come to us, they say, oh, the last time I did a transaction, I didn't quite have the right experience.
Yes.
It wasn't too good. So I personally have asked this question. So, okay, how did you find that realtor? Oh, I didn't interview realtors. I worked with a friend or a cousin.
Yes.
There's nothing wrong with that.
Yes.
As long as they have the right experience and they can, give you the right value.
Yeah.
Because I feel it's a big decision you're making when you're buying a home. You're putting hundreds and thousands of dollars on the line. So give this process the respect that it deserves. Shop around in terms of interviewing a lot of people. Make sure somebody you're working with has the right experience, the right qualification, and they can get you the best deal, both in terms of the house as well as the rate. And that's where I believe, having a power team and setting yourself up for success right from the get-go is super important.
Absolutely. It's really in the borrower's interest. I hear all the time, we spoke to the broker a couple of times, or we spoke to this person a couple of times. And I say, okay, so after you closed, what happened? Oh, nothing. Well, as a broker, yes, our job during the process is very intense, but it's even more important to be present after the process is done. Once the house is funded, once you're moved into your home, because you know what? You are going to have questions, and you need to know that there's somebody there that you can call, be it myself, be it Shay, or whoever it is that you're dealing with. It's important for the client to know that, that support is not just there during the process, but that support is there for the lifetime of the mortgage and beyond.
Right.
Because, you might decide in 2 years that you don't want to live in that house anymore. Are you going to start looking for a new broker all over again when you already have one? And you already have a good relationship? You have a good relationship with your broker and your realtor, you're not going to go anywhere else, right? So it's very, very important to establish those relationships before you even start house hunting, or, once you have the seat that you want to purchase a home, start talking to people. Talk to your friends. See who your friends used as brokers. Were they happy with them? Because you know what? Referrals, those are the best clients. Right? We love referrals. We love to hear, you know what? We heard from you from a friend. They were very happy with you. So that establishes the relationships.
Right.
So it's very important to know that the person who's helping you through the process is going to be there after the process as well. And that's key.
Right. And now that we've focused a lot, I guess, on first-time buyers, let's also talk a little bit about investors. Now, one challenge that I see ever so often with clients is they have a primary residence, they might have 1 or 2 investment properties as well. But when they go on trying to purchase their 3rd or 4th, they go to the bank or even some mortgage advisors, and they are unable to get a mortgage because, as per banks and some mortgage advisors, at that point they're over leveraged. So they are not qualified for getting any more mortgage, any more investment properties. But as clients, they know they can afford it, and they have it in them to improve and increase that portfolio. Now, what are some of the things that a client or as an investor one needs to do to set themselves up in the right fashion right from the get-go again, where once they are in a position to invest in their second and the third and the fourth door or investment property, they are able to do so without any problems?
You know, it's really important to have financial stability. If you're going to be an investor, it is really important that you have financial stability. Not just with your real estate, with your home, but just a healthy bank account, essentially. It's just, when they say, saving for a rainy day. If you are getting into a second property, and you have enough equity to bring out from your current home, then that's why to start. But when you start speaking to the broker or the bank, well, I'm not so sure. I'm only going to speak about the broker channel. I'm not going to speak about the banks. Align yourself with a broker who understands the process. But not just that, it is very lender specific on how many doors, what we call doors in the broker channel or properties, are acceptable for a lender as far as risk is concerned. Okay, so if you're buying your second property, speak with your broker, and you always have to make sure the broker is very transparent with you. You have to be honesty is a two-way street, broker and client, in any industry really, right. And make sure that the first lender that you come into, or the lenders that are presented to you as options, accept, let's say, 4 to 6 doors. Okay, 4 to 6 properties. So you're on property number 2. It's going well. Now you're looking to go to property number 3. You already have a lender who is comfortable with 4 to 6 doors. So you don't have to stress about finding a lender who's going to accept another property in your portfolio. Okay. When you become an investor, what's really important to keep in mind is that you're not going to have the lowest rate. Okay, the rate that you had as a first-time home buyer or as a second-time home buyer, that's not going to be the rate that you get. You are now in a higher risk category when it comes to funding. Also, what lenders will look at is, can the borrower, fund the mortgages from their income, whether it's rental income, your own income. Is there enough money coming in every month for the borrower to be able to cover the cost of the mortgages that are due, the financial responsibilities that are due every month from having multiple properties? So those are the things that are looked at. Once you get to, let's say, 4, 5, 6 doors, and that lender is done, then you may have to move into, if you still want to keep increasing your portfolio, then your broker may take you into the alternative channel for financing.
What do you mean by that?
Alternative channel is a channel where there is more leeway. There is more, how should I put this? There is more leeway. There's more flexibility, if you will. However, you might want to consider a holding company to protect your properties. Holding companies are very specific. They're very complicated in structure, and those are best done through accountants and through lawyers. You need a good accountant and a good lawyer to set that up for you, and you can have your properties inside the holding company, which protects them. So let's say if you were to have financial issues on your own, your properties are protected inside the holding company. That is something that is done through an accountant, a lawyer. We do the funding, but the setup itself is done through the legal channel. So
right. And do you need to have like one holding company wherein all your investment properties can be under, or do you need to have different holding companies for each investment you make now? It's expensive to set up a holding company. So, I don't believe, and I'll be happy to look into this, I don't believe that there is a limit of how much you can have within a holding company. If you're a sole proprietor or if you have partners, then it's whatever the division may be, the asset allocation may be between the shareholding, may be between the partners. It is expensive to set up a holding company. So if you're setting up a holding company for each property, it's going to cost you a lot of money. If you have, let's say, 5 to 10 properties within one holding company,
That's all you need. Unless you're planning on building an empire, then, I don't, and you have the money to spend on multiple holding companies, then, that's totally up to you. But I would definitely consult an accountant and a lawyer for that. I wouldn't want to give you any wrong information. So.
Absolutely. No, I appreciate that. But let's talk about building empires. So why not, right?
Why not build
It's
empires?
our podcast. We talk
There
about
you
whatever
go.
we want.
That's it.
So what if somebody knows that, yes, I'm a first-time buyer right now, but 5 years down the line, I am going to have 15 doors, come what may, right? Or they know that they have the support and the backing and the money to do it. What's the best way then? Should then we be looking into multiple holding companies, or the one holding company structure still works, or is there a different approach altogether that we now need to take?
I would start small. I would start, but I'm conservative. So
Yeah.
I'm more conservative, right? So I would start with one. I would start with a holding company and see how far I can take one. And, I would rely on my accountant and my lawyer, to be honest. They are the ones that can guide me in the right direction as far as the size is, and as far as, what am I going to draw from the holding company? What am I drawing revenue from them? Am I keeping all the revenue in the holding company? Am I going to be investing outside of real estate within the holding company? So the structures are very complicated. And so for that, I would say, speak to your accountant. Speak to your lawyer.
Fair enough.
Yeah.
Fair enough. Now that we've covered investors as well, let's get into the speculative mode and talk about the 2025 real estate.
Are we going to look
market.
into the crystal ball?
I left it at home today.
Did you?
I'm sorry. I'm sorry. Left it at home today, but I will get it tomorrow.
Okay.
But for today, let's just do it without the crystal ball.
Okay.
So I can give you my initial thoughts, and then let's discuss.
Okay.
So I think we are at the cusp of some major changes right now.
Yes.
When it comes to the real estate industry in the GTA specifically, throughout Canada, but let's focus on the GTHA, the Greater Toronto and Hamilton area. Now, we talked about one or a couple of these changes, which is the interest rates. We've had about 5 interest rate cuts. The prime rate, which was at one point at 7.2, it's down to 5.45 at the moment. The overnight lending rate is at 3.25. So the affordability is definitely improving as we see more interest rate cuts come in 2025. The second is the 30-year amortization we talked about for first-time home buyers. The third is the insured mortgages being increased to 1.5 million, from 1 million. And then the biggest of them all, in my opinion at least, the seasonality of the market. Because even though for the last 2 years, the interest rates have been super high, spring markets have still been hot. Spring markets have still seen 100 to 150K increase in just about 4 to 5 months, and then they come back down. So overall, the market's been flat, but spring is always hot, at least for the last couple of years. That's the trend we've seen. Now, going into 2025, I would think that spring is still going to be the same, right? The prices are going to go up. Come the summer break, things might flatten out, and they might remain flat for the rest of the year, even go down a little bit towards the end of the year. But is it still a good time to perhaps enter the market? In my opinion, yes. This is not just a realtor speaking, but this is somebody who's looking out for properties right now for himself as an investor. I think it's a great time to get into the market.
It's the best time, really.
It's the best time, especially if you're looking at condos.
Yeah, it's the best
right?
time.
Because we have about 9,000 active condo listings in the market right now as we speak. So the supply is very, very high. The competition among the sellers is very, very high, which means on the buy side now we have tremendous opportunity, right? We have the time and we have the options to go through. And then, people are not fighting like cats and dogs to just get that one product.
That's right.
Which was the case a couple of years ago.
Right.
But I'll stop here. I know it was a long spiel. But what do you think how the market might take shape going into the next few months?
I think that the people who have been holding off to purchase a home are hungry. They want to buy a home. And, once we get into February, March, I think people are already out there looking. And people who are out there looking right now, they're the serious ones. They're the ones that really want to get into the market. Now, I say this, the condo market has taken a beating. It really has taken a beating, but don't underestimate it. It is one of those markets that everybody says, yeah, condos. I said, but you know what? If you're a first-time home buyer, even if you're still living at home, let's say you have a job, you don't think you can afford to live on your own, but buy that condo as an investment. You're still living at home. You don't have to worry about rent. Buy it as an investment. It gets your foot in the market. Hold on to it for 2 or 3 years. The market, the condo market always rebounds slower. It doesn't appreciate as much as a house, but it is a property. It gets your foot in the door and it gets you started. And it also starts, a portfolio. You might build enough equity in a condo to be able, depending on your down payment, of course, to be able to take some equity out and buy yourself a house. And now you have 2 properties, one that you can live in and you still have your rental that is being paid for by a tenant. So, don't underestimate a market that has been beaten down these last few years, or that doesn't hold the same value as a house. Whatever you might be, whatever your expenses might be in a house, they're not the expenses in a condo. So on some levels, you're saving money. On some levels, you're balanced, right? I think the market will heat up this summer or this spring. People are hungry. People want to get their foot in. And now with the lower rates, the higher cap on insured mortgages, I think it's going to be a game changer for a lot of people, because instead of being pushed out of the city, now they'll be able to afford something in the city or in a different area in the city. So I think we're going to see a very, very strong spring market this year. And it'll probably carry through the summer. I wouldn't be surprised if it carries through the summer.
Yeah. And with condos, I'm going to share some insights now which have come up after a lot of data analysis. I'm just kidding. No, they have, really.
I trust you.
Yeah. So what people are not thinking about is, in my opinion, yes, the market is, beat down at the moment.
Yeah.
There's a lot of inventory and people, like, as you said, condos. I mean, who'll buy a condo right now? But hear this. Now, pre-construction or resale, it's essentially the same market.
Yeah.
Right? So in pre-sale or pre-construction, not a lot of projects have been launched in the last 2 years.
Right.
And whatever has been launched hasn't sold.
That's right.
Now, with pre-construction, the rule here in Ontario is that unless 70% of the condos are sold in pre-construction, the financing for starting the construction is not approved. So for all those projects that were launched in the last 2 years, the financing either has not been approved or it won't be at all. So many projects might go into receivership.
Yeah.
And the GTA market
And some have already.
Some have already, yeah. So the GTA market is used to getting about 20,000 condos every year from pre-sale to reconstruction, which means 20,000 new condos get built and get added to the resale market. Now, for the last 2 years, if no projects have been launched or no constructions have started, the deliveries that were supposed to come 3 to 5 to 7 years from now, depending on the different projects, are not coming, right? So that 20,000 number, if we go into 2027, 2028 and further down, that number gets reduced to about 3,000. I mean, anywhere between 1,000 and 3,000. The population is increasing, right? Our targets have been lowered, yes, from 500K to about 385K. A change, but not a massive change.
Right.
And statistically, we know about 45 to 55% of all new people who come to Canada come to the GTA. So the population is still increasing. Meanwhile, the supply will really dry out towards the end of the decade, which tells me, the data tells me that the condo market will be flipped on its head. And the prices are really going to skyrocket towards the end of the decade, where the supply is nowhere to be found while the demand is still there.
That's right.
So everybody who's ignoring a condo right now might just regret it massively a few years down the line.
That's why I'm saying do not underestimate the low value of the condos right now, because it will rebound. And you know what? If you want to get your foot in the market, there are a lot of units out there right now, even on assignment. You have some beautiful, beautiful units being sold on assignment of borrowers who purchased 3 or 4 years ago who can no longer afford those units.
Yeah.
So you know what? It's a market that's being overlooked, and it's a market that's not being, it's being ignored actually.
Yeah.
And it's steering the public, or it's steering people in the opposite direction. And it shouldn't, because you know what? Getting your foot into the real estate market is key. And if it's a small unit, so be it.
Right.
But your foot is in the market.
Yeah.
You already have, that in itself increases your purchasing power when you go into the next property.
Absolutely.
So that's my opinion on that.
Right. And final take on the 2025 market then.
It's going to be a great market.
Yeah.
Yeah, I think it's going to be a good year for anybody who wants to purchase a home. And it's going to be a year of, you know, some very positive changes have been made for the industry. Some long-awaited changes have been made for the industry. And I really hope that, you know, it entices young families and new families in Canada to get into homes and establish themselves and you know, build a security for their retirement and wealth essentially as well. So I think it's going to be a really good year compared to the last 3 years that we've had.
Yeah. I hope so. And I do believe as well that the worst is behind us.
Yes.
In terms of the shitty real estate market that we've been in, and I don't mince words.
I can see that.
I don't swear, but I don't mince words otherwise. So yeah. So I do agree with you. I think it's going to be a strong year, not just for us as professionals in the industry, but also for home buyers, home sellers, investors, everyone. Because there are, as you said, changes coming into the market, which will improve things in terms of inflation, affordability, you know, monthly payments for everybody who's in the market.
Absolutely. And, you know, of course, as you know, professionals in the industry, we want it to be a stellar year for us. But, you know, I always say the priority is the borrower. You know, let's get them into the homes, and that is really our success.
Exactly.
Our success is seeing our clients and future clients, you know, getting settled in their homes, and you know, hopefully they'll keep coming back to us. So that's success to me. Yeah.
Absolutely. All right, Sonia. Thank you so much for doing this. Really appreciate your time, and hopefully we'll have you back maybe next year. Who knows?
Thank you, Shay. You never know. It was an absolute pleasure. Thank you so much for inviting me and having me here.
Thank you for taking the time. Appreciate it.
Thank you.